Welcome to our video. We're going to talk about what's the best way for you to use your TFSA. Well, let's start by defining what a TFSA is. And of course, it's a tax-free savings account, right? This is probably one of the biggest misnomers regarding TFSAs. It is much more than a savings account. It is really a tax-free investment account. I mean, within that account, you can hold stocks, bonds, mutual funds, ETFs, basically any investment, almost any investment that would qualify to be used as an RSP in your RSP can also qualify to be used within your TFSAs. So you can look at a TFSA as an area where you can build and grow a lot of wealth tax-free. Now, before we start talking about how much can you save or how much value can you save within your TFSA, we have to understand how can investments get taxed? How are investments taxed? Well, essentially, we can kind of lump investment taxes into three different categories. Number one, we have interest. So when you hold certain investments like bonds, principally bonds, they will generate interest, and basically they'll generate interest every year, and every year come tax time, you need to pay taxes on the interest that you would have earned. And quite simply, whatever interest you earn on your investments, you'll pay that at your marginal tax rate. So if your marginal tax rate is 30% or 36%, that's what you're going to pay on the interest that's earned. Interest is considered the most inefficient investment from a tax perspective. Okay, so just know that when on a per dollar basis of dollar earned in interest, you're going to pay the most tax there on the interest. Okay, so that's number one. Is that's how you can get taxed based on interest. You can also get taxed with capital gains, and what capital gains is essentially, the way that it works is that if you buy, let's say, a stock or a mutual fund and it grows in value over multiple years. So let's say you bought $10,000 worth of investments and it grew in value to $15,000 after 5 years later. So you've got $15,000 at the point when you withdraw that money, when you withdraw that growth of that $5,000 growth, that's when you have to pay the capital gains. Okay, and the formula that it works is that you pay taxes on half the growth. So if you've got $5,000 of growth, then you're going to pay taxes based on half of that amount, on $2,500. And if your marginal tax rate is 30%, well, you're going to pay 30% on $2,500. So because you're paying taxes on half the growth with capital gains, capital gains are considered the most efficient investment from a tax perspective. And next we have dividends. Well, if you may be wondering, what is actually a dividend? Well, essentially what happens is if you buy a company, if you buy a stock in a company or even a mutual fund of several companies, and those companies have profits, they may decide to share that profits with their shareholders. And basically you'll receive that in the form of a dividend. A dividend is basically you are participating in the profits of a corporation. That is what a dividend is. Okay, but how you calculate the tax of the dividend gets complicated because the company has already paid some tax on those profits already, and you have to pay your share. And how your share is calculated gets a little bit complicated. But generally speaking, for the purposes of this video, it's good to know that when you receive dividends, you pay taxes in the year that you receive those dividends. And from a tax efficiency perspective, it's kind of in between interest and capital gains. So it's not as bad as interest. It's not as good as capital gains from a tax efficiency perspective. So it's a kind of a Goldilocks, just right in the middle kind of deal. But for the purposes of this video, for the rest of this video, I'm going to focus more on capital gains. So we're going to go through some examples, and all those examples will be based on you having to pay a capital gains on an investment. So here we're going to start by looking at a quote-unquote short-term investment time horizon of 10 years. So looking at 10 years, we're going to put $10,000, let it sit there for 10 years, and let it grow. And we're going to assume here that you've got an investment that is earning a steady 7% annual rate of return. Just to be clear, that 7% is just an assumption. There is no investment out there that's going to guarantee you a 7% rate of return for a 10-year period. Okay, but we'll just assume that for now. And if you put that $10,000 in, then basically it's going to basically almost double in value after that 10-year period. That you'll get an investment growth of $9,600 after that 10-year period is up. And let's just say after that 10-year period, you want to take the money out. You want to use that money to, I don't know, go on a trip, buy a vehicle, whatever the case may be. And if you invested that $10,000 in a regular investment account, like what we call an open or a non-registered investment account, well, you've got to pay a capital gains. And if you're looking at here, if we follow our formula, that capital gains will be half the growth. So half the $9,600 is $4,800. We'll assume a marginal tax rate of 36% here. You're going to pay a capital gains of just over $1,700. So that's what you're going to pay from a tax perspective when you take out that money after that 10-year period. When it comes to capital gains, again, you don't pay as you go necessarily. You only pay when you withdraw, when that growth is finally realized in your pocket. Okay, and now we could have, instead of putting that $10,000, we could put that, instead of putting that into an open investment, we can put that into a TFSA investment. And then, again, same 10-year period, same investment, same kind of stock or mutual fund that you would buy, and basically you will have almost double that money. But because you put that into a TFSA, there are zero taxes due when you withdraw that money. So that's pretty powerful here. We've saved ourselves, a good, almost saved ourselves more than $1,700 in this case. So not bad, right? Now let's look at a long-term horizon. Let's look at 30 years out. Let's say you put that $10,000 and you just let it sit there and grow with those investments for a 30-year period, and then you take it out. And here, basically, in an open investment situation, if you just leave that money invested in those securities for 30 years, you'll almost 6 times or almost 7 times your money in growth. So you'll realize over $66,000 worth of growth at an assumed, again, this is just an assumption rate of 7% per year annual compounding annually for 30 years. So that's pretty good, right? Basically, now at the end of that 30 years, you want to take that money out. You want to go on a trip. You want to do that, a trip of a lifetime, because you want to take out all your money for that. If this was invested in an open investment account, you'd have to pay nearly 12 grand worth of taxes. Again, the formula applies here. The growth is 66, so we chop that in half. So we now have a $33,000 basis for income multiplied by your marginal tax rate. That is your tax burden that you'd have to pay at the end of the period. So, well, kind of sucks, but at least you made some growth. Now, again, that $10,000, you had a choice. You could have put that just in a regular investment account where you eventually have to pay taxes on it, or you could have put that in a TFSA investment account and then let it grow there. And of course, here, there is no taxes. You don't have to pay taxes on that when you take that out, which gives you a realized savings of nearly $12,000. So that's pretty good. Again, looking at TFSA from a long-term perspective has delivered a significant amount of value in terms of tax savings. Now, again, one of the classic questions, TFSAs, go long or go short? And this is a question, there's been many articles that have been written about this, and that a lot of people are thinking TFSAs from a short-term perspective. And even here, we've looked at, this 10 years is a little bit radical to be thinking short-term here. A lot of people, they're looking at TFSAs, they're looking at a 2, 3, 4, 5 year time horizon. Again, how much can your money grow in 2 or 3 years? Not much. So, how much taxes are you going to save? Not much. But if you're looking to save for the long term, the savings opportunity is much higher. So again, here's another thought exercise. Let's say we had 3 10-year periods where we saved $10,000 for each period. So in period 1, we would invest $10,000, let it grow, withdraw the money at the end, take it out, use it for something, put another $10,000 in it again, let it grow, pay some taxes, withdraw it, pay some taxes, use it, and then put another $10,000 in. So this is 3 consecutive periods where we just invested $10,000, we left it in that invested for 10 years, and And again, what's their tax savings opportunity at an assumed rate of return of 7% is just over $5,000. But if we look at a long-term perspective, oh boy, that's just investing $10,000 once and leaving it grow for 10 years and realizing a great growth. And again, this is an assumed rate of return, a tax savings opportunity of nearly $12,000. So again, short-term, this is your tax savings opportunity. Long-term, this is your tax savings opportunity. And again, this is an exaggerated short-term. This is, most people don't leave their money in their TFSAs that long even. And again, we're only using capital gains as an example here for the basis. So that means we're even comparing the most efficient tax investment tax out there. So it really shows, basically how much money can be saved going long with your TFSAs. Now, all the examples we've talked about here so far has been based on $10,000 worth of investment. And one thing that we know is that you have more than $10,000 worth of TFSA contribution room available. In fact, if you're in a household with two spouses, there is much more contribution room available, right? So with two people, the contribution room is up to $139,000 worth of contribution room that you have available. And that's assuming that you've been 18 since the year 2009 when the TFSAs were introduced. So there's a tremendous amount of tax savings opportunity out there that realistically looking at it, the vast majority of Canadians are not taking advantage of and don't have a plan in place to take advantage of these opportunities. And I'm not going to name a figure here in terms of, or give you a number in terms of what is a tax savings opportunity for your full TFSA contribution room. It really depends on your situation. Whether you're young in your 20s and 30s, or you're approaching retirement, the situation would be different. What are your goals? What's your situation in life, et cetera, et cetera. So the point I'm trying to make here is that TFSAs need to be an important part of your financial plan. If it's got a tremendous opportunity, and it's especially when you look at the long term. In fact, I would counsel to say, look at TFSAs not only from a long-term perspective, but look at it from a real long perspective, if you have that opportunity. Look at it from an estate planning perspective. Look about how, TFSAs need to play a large factor in terms of how do you want to transfer wealth to your children, from when you pass beyond the point where you pass away and your spouse passes away. Look at it from a late retirement planning perspective. TFSAs are really powerful there. Some important points to note about TFSAs and retirement is that the income and withdrawals from a TFSA are essentially, quote unquote, invisible to the government. Okay, the government knows how much money you have, how much money you take out, and how much income you get. I'm not trying to say we're hiding money from the government, but when it comes to old age security eligibility and even guaranteed income supplement eligibility, TFSA income and gains do not factor in to those factors. That's huge, because for old age security, once you start making a certain amount of money, right now it's the limit is sitting at around $76,000. Once you make more than that in retirement, then some of that money that you would receive for old age security checks starts getting clawed back up to a point where you don't get it anymore if you make over a certain amount. And for some people, guaranteed income supplements. So if you're, middle to upper age, and you're trying to save money, put money aside for your retirement, and you want to have a modest retirement, TFSAs need to be really considered in your plan, so that you don't sabotage yourself from being disqualified from using old age security or guaranteed income supplement if you can qualify for it. So that becomes really important here to think this through. Next, obviously, it keeps your marginal tax rate pretty low in retirement. So that's another point of trying to limit taxes in retirement even further. So really important things to know about TFSAs. A couple of other warnings. Don't use TFSAs, and this is my personal advice. Try not to use TFSAs for speculative investments. You got a buddy who's got a stock tip and you've got some high confidence in a particular stock tip, but here's the risk. If you apply that stock tip within your TFSA, and let's say you invest $10,000 into a speculative stock, and it goes belly up, it doesn't go well, you lose that contribution room, right? If you invested $10,000 and that investment sank to like $500, investment's never going to recover, that contribution room is gone with it. Okay, so just be aware of that. Best thing to do with the TFSA, very simple. Have a well-diversified portfolio in your TFSA. Make sure it's according to your time horizon. It's invested according to your time horizon and your risk tolerance. And it's invested with good, reputable companies or investment firms. So really important to guidelines in terms of how to use your TFSA. And for the most part, most of your investments should follow that rule. Don't use TFSAs for day trading. If the CRA determines that you're using TFSAs for day trading, they could basically charge you taxes on that, because then it's kind of considered an active income for you at that point in time. Last, but really important, if your province allows a successor holder to be appointed to your TFSA, because I've talked about using TFSAs as a long-term means. This is really important. So if you can appoint a successor holder, and for the most part it'll be limited to be your spouse or your common law partner, what this means is that your TFSA, once you die, doesn't necessarily have to be liquidated. Okay? For many people, when they die, the investments have to be cashed out, and then taxes are owed based on that. Well, for a TFSA, that if a successor holder has been appointed, the TFSA continues after death, and the funds and the investments in there can continue to be managed by the successor holder, and that growth continues to be tax-free. And as long as the successor holder is alive, that TFSA can remain in place. So really important. That's a really important feature, because if you've got a 10-year period between one spouse passing away and the next spouse surviving, that's a tremendous value in tax savings that can occur over that 10-year period. Really important to know. So again, if you're not sure, call your advisor or call your bank to make sure that you've appointed a successor holder, if your province allows it. Some provinces don't, into your TFSA. That's one really important parting note. So with that, I wanted to share this. This is probably one of the most critical pieces of financial knowledge that needs to be known by, I would say, every single Canadian adult out there. And if you have friends and family who you think would benefit from this information, please go ahead and share this with you. I am passionate about sharing information, about trying to help people win at the money game. So please share that out. If you need some help, if you got some further questions about how to do things in your own portfolio, don't hesitate to give me a shout. I've got my contact information on the slide here, but there's also a little button below where you can schedule an appointment, an online appointment, where we can get together and chat over Zoom. All right, well, I'm going to leave it there. And remember, be intentional, because anything else is a waste of your time. Thanks.